Silver just broke above $60 per ounce for the first time in history. But that's not the shocking part. For 7 straight years, the world has consumed more silver than it produces. Every single year since 2018, global demand has outstripped supply. In China, silver warehouse inventories just crashed to 10-year lows, while their factories desperately need the metal for electronics, solar panels, and manufacturing. Meanwhile, something extraordinary is happening in Shanghai. Physical silver there is trading at massive premiums over Western paper prices, sometimes $15 to $20 higher per ounce. And here's what should terrify you. This is exactly what happened in 1934 when the US Silver Purchase Act drove China off the silver standard and collapsed their monetary system. The same pattern of supply concentration and price manipulation that destroyed silver-based currencies throughout history. The cheap silver window under $50 per ounce has permanently closed, and most people have no idea the price lock is already here. For over 4,000 years, silver served as the backbone of monetary systems across every major civilization because it possessed the 3 essential qualities of real money: scarcity, durability, and universal acceptance. From ancient Mesopotamia to imperial Rome, from medieval Europe to the vast Chinese Empire, silver coins and ingots facilitated trade, stored wealth, and provided a stable measure of value that transcended political boundaries and cultural differences. This wasn't accidental. Silver's natural properties made it impossible for governments to manufacture at will, creating an automatic constraint on monetary expansion that protected citizens from the devastating effects of currency debasement. Between the 16th and 19th centuries, the most dramatic example of silver's monetary power emerged through the massive flow of precious metals from the New World and Japan into Ming China. European merchants discovered that silver held dramatically higher value in China than in Europe, creating a persistent arbitrage opportunity that drove global trade patterns for over 3 centuries. Spanish galleons carried Peruvian and Mexican silver across the Pacific, while Portuguese and Dutch traders shipped Japanese silver through Southeast Asian ports, all destined for Chinese markets where the metal commanded premiums of 50 to 100% above Western prices. This flow concentrated the world's silver reserves where demand was strongest, establishing China as the ultimate destination for global precious metal wealth. The Chinese understood what modern economists deliberately obscure. Silver-based monetary systems create natural price stability because money supply cannot expand faster than mining output. Under China's silver standard, which persisted into the 20th century, ordinary citizens enjoyed remarkable purchasing power stability across generations. A Chinese farmer in 1850 could expect his silver coins to buy roughly the same amount of rice, cloth, and household goods as his grandfather's silver had purchased 50 years earlier. This monetary stability enabled long-term savings, predictable business planning, and intergenerational wealth preservation that benefited entire populations rather than financial elites. The destruction of this system reveals the deliberate pattern of monetary manipulation that continues today. In 1934, the United States government passed the Silver Purchase Act, authorizing massive silver purchases that drove global silver prices sharply higher. This seemingly domestic policy had devastating international consequences, particularly for China, whose silver-based currency system suddenly became unsustainable as silver reserves flowed out of the country toward artificially high American prices. Within 1 year, China lost over half its silver reserves, forcing the government to abandon the silver standard and adopt a paper currency system in 1935. This transition marked a crucial turning point in monetary history because it demonstrated how foreign governments could weaponize silver markets to destroy stable monetary systems in other nations. Once China abandoned silver backing, Chinese citizens lost access to real money for the first time in millennia, leaving them vulnerable to currency debasement, inflation, and systematic wealth extraction through monetary manipulation. The Chinese government, no longer constrained by silver reserves, could print paper money at will to finance military spending, social programs, and debt service, gradually eroding the purchasing power of ordinary savers. The pattern established during the 1930s reveals the fundamental mechanisms still operating today. Control over hard assets enables control over money supply, which enables systematic wealth transfer from citizens to governments and financial institutions. Historical silver flows and disruptions matter because they demonstrate how precious metal scarcity and concentration determine monetary sovereignty, and how disrupting these flows can collapse entire currency systems, leaving populations defenseless against monetary debasement and inflation. Since 2018, global silver markets have experienced an unprecedented structural crisis that most investors fail to understand because they apply conventional commodity analysis to a fundamentally different asset. Unlike oil, wheat, or copper, where higher prices typically incentivize increased production within months or years, silver operates under a unique constraint that makes supply response nearly impossible, regardless of price levels. This constraint stems from silver's role as primarily a byproduct of mining other metals rather than the primary target of extraction, meaning that approximately 70% of global silver production comes from mines focused on extracting copper, lead, zinc, and gold, with silver recovered as a secondary material from the same ore. This byproduct nature creates a devastating supply trap that financial institutions deliberately obscure from public understanding. When silver prices rise dramatically, mining companies cannot simply increase silver output because their operations remain constrained by demand for the primary metals they extract. A copper mine, producing silver as a byproduct, cannot double silver extraction without first doubling copper extraction, which depends entirely on copper market conditions rather than silver prices. This fundamental disconnect means that even as silver prices have surged from $15 per ounce in 2018 to over $60 in 2025, global mining output has remained essentially flat or declined in many regions. The situation has deteriorated further due to declining ore grades across existing mines, a phenomenon that mining executives acknowledge privately but rarely discuss publicly. Silver ore grades have fallen by approximately 40% over the past 2 decades, as easily accessible high-grade deposits become exhausted, forcing miners to process exponentially larger amounts of rock to extract the same quantity of silver. This grade decline increases energy costs, equipment wear, labor requirements, and environmental impact per ounce of silver recovered, making many previously profitable operations economically marginal even at elevated silver prices. Environmental and regulatory constraints have compounded these natural limitations by creating additional barriers to new silver production that previous generations of miners never faced. Modern mining operations must navigate complex permitting processes that can extend for years or decades, environmental impact assessments that frequently block or delay projects, and increasingly stringent waste management requirements that add substantial costs to extraction operations. These regulatory frameworks, while often justified on environmental grounds, effectively limit silver supply expansion regardless of market demand or price incentives. Secondary silver sources through recycling and scrap recovery have increased modestly but remain inadequate to address the growing supply deficit. Industrial silver applications in electronics, solar panels, automotive components, and medical devices typically embed silver in ways that make recovery difficult or economically unviable. Unlike gold jewelry that can be easily melted and refined, silver used in industrial applications often becomes permanently integrated into products that eventually reach landfills rather than recycling facilities. The mathematical reality of this supply constraint becomes stark when examining consumption patterns since 2018. Global silver demand has averaged approximately 1 billion ounces annually, while mining output has declined to roughly 850 million ounces, creating a persistent structural deficit of 150 million ounces per year. Over 7 consecutive years, this cumulative shortage exceeds 1 billion ounces, equivalent to more than one entire year of global mining production. This chronic deficit has forced the market to rely on above-ground inventories and government stockpiles accumulated over previous decades, but these sources are finite and diminishing rapidly. The structural supply deficit reveals why conventional technical analysis fails to predict silver price movements accurately, because the fundamental economics underlying silver differ completely from typical commodity markets, where supply responds predictably to price signals. China's dominance in global silver markets represents far more than simple industrial consumption, because the nation functions as the ultimate destination for physical precious metals, continuing a historical pattern that has shaped monetary systems for centuries. As the world's largest manufacturing economy, China consumes approximately 600 million ounces of silver annually, representing over 60% of total global demand. But this consumption differs fundamentally from Western investment patterns because Chinese demand stems primarily from industrial fabrication rather than speculative trading. Chinese factories require massive silver quantities for electronics manufacturing, solar panel production, automotive components, telecommunications equipment, and advanced battery technologies that power the nation's transition toward electric vehicles and renewable energy infrastructure. This industrial silver consumption creates irreversible demand because silver used in manufacturing becomes permanently embedded in products rather than stored as recoverable bullion, meaning that Chinese silver demand effectively removes metal from global circulation rather than simply transferring ownership between investors. Unlike Western silver markets, where exchange-traded funds and futures contracts create paper claims on metal that may never require physical delivery, Chinese industrial demand requires actual silver ingots delivered to factories and converted into finished products that eventually reach consumers worldwide. This fundamental difference means that Chinese demand cannot be satisfied through financial derivatives or paper contracts, creating inflexible physical requirements that must be met regardless of price levels. Recent developments in Chinese silver markets reveal the approaching crisis that Western analysis deliberately ignores or misunderstands. Silver inventories at the Shanghai Futures Exchange have collapsed to levels not seen since 2014, dropping from over 1,000 metric tons in 2020 to fewer than 200 metric tons by late 2025. This inventory depletion represents far more than temporary market volatility, because it demonstrates structural imbalance between Chinese silver demand and available supply, forcing Chinese manufacturers and investors to compete for increasingly scarce physical metal, while Western markets continue operating through paper trading mechanisms that disguise the underlying shortage. The emergence of the Shanghai Divergence provides the clearest evidence that global silver markets are fracturing along geographic lines as physical scarcity forces price discovery in regions with genuine industrial demand. Silver prices quoted on Shanghai futures exchanges now consistently trade at substantial premiums over London and New York spot prices, with spreads frequently exceeding $15 to $20 per ounce during periods of acute shortage. This premium reflects real supply constraints within Chinese markets rather than speculative enthusiasm, because Chinese industrial users require actual metal delivery rather than cash settlement of futures contracts. These price divergences mirror historical patterns that preceded major monetary disruptions, particularly the silver crisis of the 1930s, when artificial price distortions created unsustainable arbitrage opportunities that ultimately collapsed entire currency systems. The Shanghai premium demonstrates that Western paper silver markets no longer reflect genuine supply and demand fundamentals in regions where industrial consumption determines price levels, creating dangerous illusions for investors who rely on London or New York pricing mechanisms to assess silver market conditions. The implications extend beyond simple commodity trading, because China's silver accumulation strategy appears coordinated with broader monetary policy objectives designed to reduce dependence on dollar-denominated reserve assets. Chinese government agencies and state-controlled enterprises have systematically increased silver stockpiling alongside gold reserves, suggesting recognition that precious metals provide monetary sovereignty advantages during periods of currency instability or international sanctions. This strategic accumulation compounds industrial demand pressures by removing additional silver from global circulation through government hoarding rather than productive industrial use, accelerating the depletion of available inventory, while Western investors remain unaware of the scope and permanence of Chinese silver consumption patterns. The fundamental deception underlying modern silver markets operates through a carefully constructed separation between paper financial instruments and actual physical metal availability, a mechanism that enables price manipulation on a scale that most investors fail to comprehend, because they assume that futures prices, exchange-traded funds, and spot quotations reflect genuine supply and demand for deliverable silver. This assumption proves catastrophically wrong, because the vast majority of silver trading occurs through derivatives, contracts that never require physical delivery, allowing financial institutions to create virtually unlimited paper claims on silver while controlling relatively small quantities of actual metal, thereby suppressing prices through artificial supply that exists only on computer screens rather than in warehouse vaults. The mechanics of this price suppression system rely on investor psychology and market structure rather than genuine metal availability. When silver futures contracts trade on major exchanges, fewer than 3% typically result in physical delivery, with the remaining 97% settled through cash payments that require no actual silver to change hands. This cash settlement mechanism allows bullion banks and financial institutions to sell massive quantities of paper silver contracts without owning corresponding physical inventory, effectively flooding markets with artificial supply that drives prices lower while creating the illusion of abundant metal availability for investors who never attempt to take delivery of actual silver bars or coins. Lease rate manipulation provides another crucial component of this hidden control mechanism, because artificially low silver lending rates signal abundant metal supply to algorithmic trading systems and institutional investors, even when physical shortages create severe delivery delays for retail buyers and industrial users. Major bullion banks maintain these low lease rates by lending the same silver inventory multiple times through complex rehypothecation schemes, where single ounces of physical silver support numerous paper claims, creating systemic leverage that multiplies the apparent supply while disguising the underlying scarcity from market participants who rely on financial metrics rather than physical availability indicators. This disconnect becomes most apparent during periods when retail investors attempt to convert paper profits into physical metal ownership, only to discover that coin dealers face severe supply shortages. Refineries cannot fulfill large orders, and delivery times stretch from days to months, despite seemingly stable futures prices. The premium charged for physical silver over paper spot prices reveals the true extent of this manipulation, with retail buyers often paying $3 to $5 per ounce above quoted market prices, while bullion dealers struggle to obtain inventory from wholesalers and mints that cannot source adequate raw material despite allegedly abundant paper supply. The trap for late buyers emerges from this carefully maintained illusion because investors waiting for technical chart patterns or futures market signals to indicate buying opportunities remain blind to physical supply constraints that operate independently of paper trading dynamics. By the time physical shortages force genuine price discovery through delivery defaults or exchange inventory depletion, paper prices typically gap higher so rapidly that investors cannot purchase physical metal at the artificially suppressed levels they observed through derivatives markets. This mechanism mirrors historical patterns used by financial elites to accumulate hard assets at artificially low prices while maintaining public illusions of abundant supply through paper market manipulation. The silver market represents perhaps the most sophisticated example of this wealth transfer system, because the gap between paper claims and physical reality has grown so extreme that the eventual reconciliation must result in dramatic price adjustments that benefit those who accumulated physical metal while punishing investors who trusted financial markets to reflect genuine supply and demand fundamentals. The convergence of multiple crisis factors in late 2025 has created the definitive moment when silver's artificial price suppression system finally collapsed under the weight of physical reality, marking the permanent end of cheap silver availability for ordinary investors who trusted paper market pricing mechanisms, rather than recognizing the systematic manipulation that kept prices artificially low for institutional accumulation. Silver spot prices broke through $60 per ounce for the first time in recorded history during early December 2025. But this milestone represents far more than simple price appreciation, because it signals the moment when physical scarcity overwhelmed financial engineering techniques that had suppressed silver prices for decades through derivatives, manipulation, and artificial paper supply creation. This price breakthrough differs fundamentally from previous precious metals rallies because it stems from structural supply and demand imbalances rather than speculative enthusiasm or monetary policy responses to economic crises. The underlying drivers include 7 consecutive years of global supply deficits totaling over 1 billion ounces, Chinese industrial demand that removes silver permanently from circulation, collapsing warehouse inventories across major exchanges, and the emergence of significant price premiums for physical metal in regions where genuine industrial consumption determines market dynamics rather than financial speculation. The Shanghai Divergence provides irrefutable evidence that the cheap silver window has closed permanently because Chinese silver prices now consistently exceed Western paper quotations by $15 to $20 per ounce, demonstrating that physical metal commands substantial premiums wherever real supply and demand fundamentals operate without derivatives market interference. This geographic price separation mirrors the silver crisis of the 1930s, when artificial price distortions created unsustainable arbitrage opportunities that ultimately forced currency system collapses. But the current divergence operates on a far larger scale because Chinese industrial consumption permanently removes silver from global circulation, rather than simply transferring ownership between investors. The forced repricing currently underway represents the inevitable collapse of financial manipulation systems that enabled institutional investors and central banks to accumulate physical silver at artificially suppressed prices, while retail investors remained convinced that abundant supply justified waiting for lower entry points. This systematic wealth transfer mechanism functioned effectively for decades because most investors relied on futures market signals and exchange-traded fund pricing rather than attempting to purchase and store actual physical metal, allowing manipulative institutions to control price discovery through paper trading while accumulating the underlying hard assets at discounted levels. Individual investors who delayed silver purchases while waiting for prices to return below $50 per ounce have been permanently priced out of the market because the structural factors driving current price levels cannot be reversed through monetary policy adjustments or economic interventions. The combination of irreversible industrial consumption, declining mining output, depleted above-ground inventories, and strategic accumulation by sovereign entities has created a supply constraint that will persist regardless of economic conditions or financial market volatility. The historical parallel to monetary system collapses throughout previous centuries, reveals the ultimate significance of silver's price lock because precious metal scarcity has consistently preceded currency debasements and systematic wealth extractions that devastate middle-class savings and retirement security. Citizens who recognize this pattern understand that physical precious metals provide the only reliable protection against monetary manipulation, but only while supplies remain available at any price, making immediate acquisition essential rather than optimal for those serious about preserving real wealth against inevitable currency system instability and continued financial manipulation by institutional elites.